Good day, learners. You are welcome to this course. The title of the course is Introduction to Finance, and the course code is DFN 211. My name is Professor Richard O. Akigunla of the Department of Banking and Finance. Actually, I know that you are from the accounting department, and the accounting courses actually include the Introduction to Finance. There is a very thin line between finance and accounting. Finance cannot do without accounting, just as accounting cannot do without finance. This course is concerned primarily by financial management, introduction to financial management basically, and it comprises of the following sections. We have 8 sections in all. We'll be looking first and foremost at chapter 1, which is the scope of financial management. It will be followed by chapter 2. Chapter 2 deals with capital market. In chapter 3, we have the language of this course, which is the language of finance and accounting. That is referred to as the mathematics of finance. That is the mathematics of of discounting, compounding, amortization, and the rest. As a course on financial management, we'll be considering the cash flow analysis. That is, with the intention of appraising the cash flow, that we need for us to see the source of cash flow and to analyze and how we go about, gathering those components that make up the cash flow. With the objective of arranging all this, the cash flow is for us to be able to evaluate it and take decisions in our investment proposal, whether the investment proposal is actually profitable or not. And we'll be looking at that at the next title, which is on the chapter 5 or section 5, as the case may be. Is on capital budgeting decision. Capital budgeting decision or capital investment decision. We have capital assets, as you know, and in capital assets, we have to decide whether to invest or not to invest on capital assets. Decision to invest on capital assets, we actually necessitate the fact that we raise fund. Raising of fund will be to finance a capital asset. But however, like we said, a business venture is nothing but venturing into the unknown world. There's risk attached. That is, there's uncertainty in the finance world. You are going into a business today, you are making capital available today, for which the expected cash flow will come in the future, which we refer to as tomorrow. And therefore, there is a lot of uncertainty between today and tomorrow. And so the risk is not necessarily involved. And there is a need for us to do a primary or an introductory way of tracking risk and uncertainty in finance, that we can incorporate that into our analysis of whether to invest or not to invest. That we capture in the 6th session. In the 7th session, we look at the sources of financing a company, moving from internal capital to external one. That means the one provided by the owners of the firm, and those that are provided by the outsiders, those that are not owners of the firm, who depends on they are receiving their interest. And we do that by evaluating the cost of the various sources and the cost of the weighted cost of all the sources together to be able to determine what is the cost of financing the investment proposal that we have decided on. We then move forward by that will be covered here, like I said, in the 7th session. In the 8th session, we'll be looking at the analysis of operating leverage and financial leverage. You can decide to operate a company without appealing to external fund, that is using basically internal fund, that is fund provided by owners of the firm. In that case, there is little risk that is involved. Financial risk is not involved. When you are using internal fund, no financial risk, the financial risk is not involved. But once you make use of debt in the capital structure, you introduce financial risk, just as it had advantage too. The advantage is the fact that when you use debt in the capital structure, is a capital that is provided by external financial institutions or individuals, and the fund will be used in in operating the business, and if the rate of return on the business is more than the cost of the capital, it's higher than the cost of the capital, then it's an advantage, which will improve return to owners of the capital. This is referred to in finance as financial leverage. Again, when you operate a business, you make use of both variable. It comprises your costs, comprises of both fixed costs and variable costs. The level in which a business must operate, your cost vis-a-vis the total revenue, the combination of the fixed costs and variable costs must actually weighed against your revenue with the total revenue. There's an area that's referred to as the break-even point. So this analysis is referred to as operating leverage, the use of fixed capital to be able to lever the operation of the company. Having said that, we'll not go into the lecture proper by going to the fourth section of the lecture, which is the scope of financial management. The scope of financial management, let's go first and foremost to the scope and concept of financial management. What is financial management? Or alternatives people refer to as strategic financial management. It's a strategic decision of a company. A company must take a decision to manage its fund, because management of finance has actually gone beyond sourcing and deployment of funds, or doing bank reconciliation, or doing imputation of how funds move in or gets out of the firm. It has gone beyond that. Here we are concerned with the management of the investment outlet, the financing outlet, and also how capital providers are remunerated. First and foremost, let's see what is our concern in financial management. Our concern here is not public institutions. Public institutions are actually taken care of in what referred to as public finance, and that's what referred to as corporate finance. Financial management is part and parcel of corporate finance. So we'll not be concerned with with public finance in this course. We'll be discussing corporate finance. That means the art of financing or evaluating or analysis or the financing decision in a corporate firm. Corporate firm, so the word firm is recurring, or you can see the word firm. What is a firm? A firm can be defined as a unit that employs factors of production to produce goods and services, making available to others, economic units, other economic units, such as individual firms, government, and therefore being able to make a profit, is able to make mark up over its cost of production and get a result, and therefore making money for the owners of the firm and other stakeholders too. The firm is therefore a basic decision-making unit, and this basic decision-making unit cannot be left, fallow, cannot be left with just anybody. A professional like the financial, managers are therefore trained to handle that aspect of the firm. You can see that finance is aching, or it has been described. Sorry, has been described as the lifeblood of an organization, the lifeblood of an organization, and therefore it needs to be well managed. Profit-making organization is our major concern here. We have not-for-profit organization that are also concerned about making profit, but here we are concerned about profit-making organization. So most of our analysis and our discussion will be centered around profit-making organizations. Profit-making organizations, therefore, they will raise funds from either the internal or external fund. They raise such fund, for investment purposes, into profitable ventures. And the sole objective of profit-making firms is to maximize profit over time. A profit-making organization, therefore, can be either a private or public organization. A private company is defined as the one which is limited by membership, usually between 2 and 50. Whereas when you talk about public organization, here is one in which a subscription outsiders are allowed to subscribe for their shares. A minimum of 7 people must actually be the limit. There are basic financial decisions financial managers are faced with basic decisions, and this is actually a concern in finance. A concern in finance, how to tackle these basic decisions in finance. The three areas in which we therefore focus on financial management are investment decision, financing decision, and dividend policy decision. Again, I repeat myself: investment decision, financing decision, and dividend policy decision. In investment decision, we are concerned about the ability of the firm to aggregate the cash flows or investment idea and then be able to evaluate this. We're not going to details here. We come to give details later when we come under capital budgeting decision. As to how you now do your analysis using the aggregated data to be able to decide whether an investment proposal is profitable or worthwhile or not worthwhile or not profitable. Having decided to invest, there might be the need for that investment to be financed, and the financing mode could be internal or external. That is, internal provided by the capital owners, the owners of the firm, or external provided by outsiders to the company. And the decision to finance, therefore, means, like I said earlier, it means that we must evaluate the various sources of finance with the intention or with the purpose of optimizing the various financing decision, that we get the least weighted average cost of capital. Since all these decisions will impact on the value of the firm. The design of the firm, actually, when we come to that, is the objective of the firm rather must not be compromised, which is value maximization. So we must take an optimal decision when it comes to mode of financing a firm. Having gone into operation, that is operating the business now, a businessman is concerned with making a markup over and above his cost. The markup is, which usually referred to as a profit, is a measure of the efficiency or the effectiveness of the company. If the company is efficient, it will be posted in terms of the magnitude of its profits. The next one is what referred to as the dividend policy. The dividend policy is a decision in which the firm is able to make return to owners of firm. Having made profit, the firm must come to an annual general meeting. There's usually what referred to for public companies as a time when they come, a time in a year when all shareholders come together to decide on the performance or evaluate the performance of the company in the outgoing year. And a decision will therefore be made as to whether dividend or profit that is made is to be declared a dividend or to be retained within the organization. So the analysis of that, the intrigues, that's involved in deciding whether to retain profit or whether to pay the profit and dividend is what referred to a dividend policy decision. There are objectives which organizations must pursue. There are objectives. There are various objectives, so many of them, which organizations must pursue. Like I told you, here we are concerned with profit-making organizations. That is, companies that are corporate firms that are listed, mostly listed on the stock exchange. Although we'll be sometimes using some unlisted firm like small and medium scale enterprises or micro, small and medium scale enterprises. In some of the examples we'll be making, because most of our discussion also apply to these small firms. Objectives of the firm are actually, like I said, varied, and we have many of them, ranging from sales maximization, market share maximization. The company doesn't want to just remain, at a level. We want to, play on its goodwill and therefore be able to maximize its share over time. So that even the company will be concerned about having industrial harmony. So therefore, it's part of the objective. You want to decide on having the management of the firm to also be satisfied with with what they are doing. All this will be an objective. Of course, a firm operates in an environment. He wants to operate in such a way that, do his CSR in such a way that, the environment will also be pleased They'll be satisfied with the operation of the company. You don't want to operate in such a way that, they will start, companies start, unions or decide to start picketing the company. They don't want to do that. But basically, you can summarize all these objectives in finance into under two major subheading: profit maximization and wealth maximization. Profit maximization is concerned with the maximization of the profit that companies made over time. And this maximum of profit maximization actually emanated during the period in which we have most of the business in the business world were small businesses. That means owners manage businesses. When you have owner managed businesses, we see that it's valid. It's not unexpected for not many businesses to want to maximize its profit over time. Its profit. And under that condition, the proponent of that business is also the entrepreneur, and it's the promoter of the business too. So it's the same person as the one that is running the business. And so it's not wrong for that individual to make profit. To want to maximize its profit. But as we find after the Industrial Revolution, we constantly find large organizations, large enterprises, in which management of the organization are actually distinct, different from, the owners, and which when you have, the owners can only intend to monitor what they are doing by the kind of objective that is put in place, which will guide the operation of the managers, the CEOs, and all that are attached to the management of the firm from time to time. So in that case, profit management may not suffice, may not be good enough in monitoring what this management are doing. Profit management, therefore, serves as utopia, as we call it in quotes, objective, because of not be able to manage, or monitor what management are doing effectively. Hence, we have what we refer to as wealth maximization. Of course, the fact that profit maximization also suffers from the fact that it doesn't take care of time value of money. It recognizes one at the beginning of the year, at the same time as that of the end of the year. It also does not take into consideration what we refer to as risk. And like I said earlier, risk is involved when you go into any kind of venture, providing of goods or services. Risk is definitely involved. You agree with me? Risk is involved. And also, we find that even the term profit is actually becoming a very volatile and term, with a lot of argument here and there of what actually constitutes profit. In terms of Chamberlain, in terms of Marshall, when profit maximization was accepted as the maximum in business, as profit was recognized as different between the total revenue and total cost, which is the profit, which is defined as the profit of our organization. But these days that we have profit definition changing depending on who is, viewing the organization, ranging from profit before tax to profit before interest and taxes, to profit after taxes. So when you talk about profit maximization, therefore, the question is which profit are you maximizing? Is it a profit after tax, or profit before tax, or profit before interest and taxes? These are different views of the organization. And because of all this, it's therefore difficult for profit maximization to remain as the leading, objective of the firm. Hence, we have what we refer to as wealth maximization. Wealth maximization, which actually takes care of the defects of profit maximization, the time value of money. Because when you talk about time value of money, wealth maximization actually it discounts the cash inflow over time. By using a discount rate, which is nothing but the interest rate, the operating interest rate in the economy. Once the cash flow is discounted, then therefore you remove the cost of the fund that is used in the firm itself. We have what we refer to as the net present value of the company. Net present value of the company tell us at a point in time if the company is actually making progress, because the net present value of the firm that will drive the market value of its shares. All things being equal, what is available to shareholders is the market value of the shares. Market value of the shares. At any point in time, you have access to the value of its share in the capital market. You can decide to sell his shares in the capital market and have his money and run away with the money, profit taking in the capital market. So for wealth maximization is able to achieve that, and that is why it is preferred over and above profit maximization as an objective. Having said that, we move to the next session, which is on sources of finance. Like I said earlier, that the sources of finance of corporate organization can be classified into two broad sections, two broad classification: owner's capital and external capital. Owner's capital provided by capital owners. In the case of PLC, that means publicly limited companies, owner's capital will represent the shareholding of the company. The company has been made an offer of the share, which we discuss in detail later, offer the shares to the public. Also, by subscribing to the shares, they become owners of the firm, part of the owners of the firm, and therefore that's referred to as the shareholding of the firm. The other is the one provided by the external institutions, individuals, and those that have invested in the company, through buying or taking up the debentures or or referred to as corporate bond or corporate stock. In that case, we find that the external fund can actually be seen in three perspectives. Number one is what referred to as the short-term financing. The one that is available within a very short period. Mostly short funds is available to SMEs or micro, small, medium enterprises and medium enterprises, whereas others we have medium-term financing and long-term financing, which may appeal to large enterprises. The quantum of finance that's available you actually determine the appeal of which source you want to make use of, whether the short-term or the long-term. The long-term sources will include all the following. Mostly, like I said, they are available in trickle. Not by, and the time period, the tenor is very short. We have those referred to as borrowing from friends and relatives, borrowing from cooperatives, and trade credits. That means whereas the company we make delay on the payments of suppliers. Others include overdraft, bank overdraft, bank loan, and factoring, trade credit and factoring. This, like I said, is available in small quantum. Others are, we have the medium-term financing, which includes term loan. As we move from short-term to medium-term, you find the level of fund that is available to actually increase in volume. Terms loan, just like is a fund provided by DMBs that will deposit money banks, to organization. The other is the company may actually want to make use of an asset, a capital asset, which it will not owe. In that case, it can decide to make use of it through a higher purchase. It pays a rate, a higher purchase rate, and at the end of the day, it makes use of asset. It depends on the agreement between the company and the higher purchase company too, whether the asset want to turn to the user at the end of the day or not. And lastly, we have the one referred to as under middle term as leasing. This comes under whether you want to lease or buy. When you buy, the buying of an asset will increase both the asset, the value, the volume of the asset on the balance sheet, as well as the debt component of the balance sheet. And therefore, company wants to avoid that. They want to do an off the balance sheet transaction by going to leasing. Leasing are of two forms. We are referred to as operating lease and capital or finance lease. In which case, the operating lease is what is available. The operating lease is available for company to be used. The difference is between operating and financial lease because is the fact that operating, in the case of operating lease, you use it, but it is not used until the starting is amortized to zero. Whereas in the case of capital lease, it is expected to be used until the capital is amortized to zero. We come into the detail of all this later on. The last one is what referred to as long-term financing. In the case of long-term financing, there are three major sources of long-term financing. We have debenture, which could be secured or unsecured. We refer to it sometimes as debenture or unsecured loan stocks. In this case, there is what referred to as debenture deeds, which is an agreement between the provider of the loan. It's like a loan, a long-term loan that is available for use by the company. It will be secured on a particular asset or floating one that is secured on a number of assets. Or it could be an unsecured one altogether. Next to that is what referred to as the preference shares. Preference share is a hybrid source, which is coming in between the first one, debenture debt, and the one that is provided by the capital owners, which are available for a very long time, which is ordinary shares. Cumulative preference shares is the type in which dividend that is not provided, that is not paid in any given years, is carried forward. Whereas in the other way around, a non-cumulative is when dividend cannot be carried forward. Instead of the interest that is paid on the dividend, on a debenture, preference, only promise fixed dividends. In participating preference, we actually want to participate after ordinary shareholders have been paid a certain percentage. They still want to further participate in the income of that company. Or in the case of a receiver coming in, we want to participate into the assets of the company. That is referred to as participating preference shares. And lastly, we have those referred to as ordinary shares. I've explained that earlier. Ordinary shares are the owners of the firm. They are shares that are raised, from the public. Those who want to be part of the company, and through various means, subscription and introduction and all these other methods in which shares are raised. The ordinary shareholders, they are part of the owners of the firm, and they therefore bear the highest share risk. They are not paid dividend until all others have been paid. The debenture holders and preference shareholders. So, but they have access to the remaining income or the revenue. The profit after all these other ones have been paid. That is ordinary shareholders. They also, like I said earlier, the ordinary shareholders, we also have access to voting at the AGM, deciding who will be the managers of the firm, the directors, the auditors, and things like that they do, at the annual general meeting. These are the functions of the ordinary shares. They could also be in category, category A, B, C, depending on the type of voting rights that they possess. This is a introduction to what we intend to cover under our, introduction to finance. We will deepen our knowledge as we move further in this area. You remember that we have just covered this following area. We look at what a firm is. We have looked at a definition of the firm, and those we are specifically concerned with the corporate firms. And we also look at what are the objectives of the firm. We have also looked at before the objective of the firm, we also talk about what is the basic finance decision, and also we are also looking at the various sources of finance. Thank you.